Before we get started, just want to give you a little background on myself for those of you who have not met me before. My name, of course, is John Vento. I'm a certified public accountant. I'm also the president of Comprehensive Wealth Management, a New York City-based CPA firm as well that specializes in working with dentists across the country. I'm insurance licensed, I'm securities licensed, pretty much anything investment, tax, accounting related. If it's financial related, I got you covered. Throughout this presentation, I'm going to encourage each of you to take notes. Note down what your question is so that you'll have an opportunity to reach out to me and speak with me about what your particular question was. Please call my office. Contact information is at the bottom of the slide. So the next thing we're going to talk about is the advantages of utilizing Roth IRA accounts. So before I jump into the details of the slide, let me just explain exactly what we mean by a Roth IRA account in case some of you are not familiar with that. So generally, when we put money into a retirement plan, the amount you put into that plan, whether it's an IRA, SEP, simple plan, pretty much any retirement plan, once you put that money into that plan, you're going to get a tax deduction up front, which is terrific. You save money immediately. Down the road in retirement, once you're no longer working and decide to start taking money out of those retirement accounts, that money becomes fully taxable to you in retirement. A Roth IRA account works in the opposite way. And what I mean by that is when you make the contributions up front, you get no current tax year benefit. But all the money you put into that account and all the earnings you're going to make not only throughout your working years, but even throughout your retirement years, every dime that you pull out of that account in retirement will be completely income tax free. Now, I believe strongly that right now we are in a situation in our country where there's going to be a major change in the tax code coming in the future. The fact that we're incurring major deficits in our country, eventually those loans that we're taking, the money that we're spending that the country doesn't have to spend, eventually that money has to be paid back. How are we going to pay back that money? Well, I think the answer is going to be there's going to be significant income tax increases in the future. Hopefully not in the near future, but at some point or another, there will be major income tax increases. This is where a Roth IRA becomes even more valuable. So if you think that in your retirement years, you're either going to be making more money and be in a much higher tax bracket, or you simply believe that tax rates are going to be significantly higher, then utilizing a Roth IRA is going to make a lot of sense for you. So let's jump into this slide now that I explained what a Roth IRA is. If you are not eligible to make a tax-deductible traditional IRA contribution because your income is too high, you may still want to make non-deductible traditional IRA contributions each year to supplement your retirement savings. You and your spouse could each contribute $6,000 each. If you're 50 or older, that number goes to $7,000 each. The big advantage here is that it will avoid the 3.8% tax, the Medicare tax, on personal investment income, but also will allow you to grow your money on a tax-deferred basis. So even if you don't qualify for a traditional Roth contribution, you always qualify to make a contribution as long as you're working and have income. Even if your spouse doesn't work, but you make at least $12,000 per year, you could contribute for yourself as well as your spouse, even as non-deductible contributions. So doing this just gives you another way to save for your retirement, and there are some minor tax benefits to it, but in a few slides I'll tell you how they could become more major. So next slide. If you qualify, you should make contributions directly to a Roth IRA account each year. Although you will receive no upfront tax saving with these contributions, all withdrawals, including your earnings, will be paid out tax-free throughout your retirement. Next part to that is if your adjusted gross income, if your overall income in the front page of your tax return before deductions and adjustments, before deductions but after adjustments, If that is below $124,000 and you're single, you could contribute the full amount directly to a Roth IRA account. If your income goes over $139,000, you can no longer do that. If you're married and your adjusted gross income is under $196,000, again, you could do the full Roth IRA contribution and you could do it directly. If you're over $206,000 adjusted gross income, all bets are off. You cannot do a direct Roth IRA contribution. If you're anywhere in between those two thresholds, you would qualify to do at least a partial contribution. So these are questions you'd have to write down and ask your accountant and tax preparer when you're ready to do your return, whether you qualify or not. So let's now assume that you don't qualify to do traditional IRA contributions that would be tax deductible, and you don't qualify to do Roth contributions. I would recommend you still do the non-deductible traditional IRA contributions. Let me read this slide to you. You can convert your traditional IRAs, the non-deductible contribution portion only, into a Roth IRA each year, so all future earnings will grow tax-free. This is referred to as a backdoor Roth IRA contribution. So let me reiterate this. It's kind of crazy to think about this, but the tax law basically says, no, you cannot make a Roth contribution because you make too much money. But then there is what's called the Roth conversion rules. They set no income limit. So anyone that has a traditional IRA account, regardless of income level, can convert it to a Roth. So the strategy we usually use is that if you don't qualify for a tax-deductible contribution or a Roth, you make your $6,000 or $7,000 non-deductible contribution, and the very next day you then convert it over to a Roth. This is why it's called a backdoor Roth conversion. So to carry this a little further, if you have no other IRA accounts and you're just doing a simple non-deductible IRA contribution, you could do this backdoor Roth conversion. Where it becomes a problem is if you have other IRA accounts that were from non-deductible contributions, then what's going to happen is your tax benefit will diminish significantly, and for some people, it may not make sense to do it anymore. So let me just read the slide to explain what I'm talking about. If you have other traditional IRA accounts that come from tax-deductible contributions or earnings, this could complicate doing a backdoor Roth conversion since your account will be taxed proportionately based on your cost basis. For example, if you have a total of $60,000 in traditional IRA contributions, but $54,000 of that came from tax-deductible contributions and earnings, and then you made a $6,000 non-deductible contribution, that basically says that $6,000 over $60,000, which is 10%, that amount will be what you could convert on a tax without paying tax. But let's say you convert over $10,000. Of that $10,000, $9,000 will be taxable on the conversion. The other $1,000 would not be because it's based on a proportion of your tax-deductible contributions versus your non-deductible contributions. So for many people, it will not make sense to do a backdoor Roth conversion, especially if you have $1 million in an IRA account right now that was generated from deductible contributions, and then you try to do a backdoor Roth conversion, you're going to end up paying tax almost on the full amount of the conversion. So you got to be very careful. A lot of people make the mistake of doing Roth conversions without fully understanding these rules. I would not recommend doing this on your own. You need to seek out the proper advice and guidance. You can't just speak to your investment advisor. You got to speak to your investment advisor along with your tax advisor so that they can look at your true full situation. So there is an approach that will allow us to work around even this dilemma. So let me read this slide and then I'll explain what this approach would be. The solution is to roll over your traditional IRAs that came from tax-deductible contributions and earnings into an existing non-IRA retirement plan, such as a 401k plan. This would leave you with only the non-deductible traditional IRA contributions, so you can avoid current year and future year tax liabilities on conversions to that Roth. So what exactly do I mean by that? Well, let's go back to that previous slide for a minute. You could see at the bottom here, the taxpayer had $54,000 that were from tax-deductible contributions. What we would do is convert the $54,000, roll it over to their 401k plan through their practice, thereby leaving them only with $6,000 in traditional IRA contributions. That $6,000 that they left in their IRA account, since that came from non-deductible contributions, now they'll be able to do that Roth conversion without any tax liability. And the better part to that is every year going forward, as long as they have no money sitting in a traditional IRA that came from tax-deductible contributions, they'll be able to do this backdoor Roth conversion every year for as many years as they're working. Again, if you have $1 million, a significant amount of money already in a traditional IRA, probably won't be worth the trouble to do this. But if you have a less significant amount, let's say up to $100,000, definitely something we want to look at so we can take advantage of this backdoor Roth conversion rule. So I know that was pretty deep, that strategy, a lot to think about. It's probably difficult to follow. My point here today is just to make you aware that there are ways to benefit from the tax code. Some of them are going to be more complex. You need to speak with an investment advisor or a tax advisor that could guide you through this step by step. This is not something you're going to do on your own. You have to do this and have your hand held every step of the way to make sure it's done the right way. So this is the cover of my book, Financial Independence, Getting to Point X. I would highly recommend that you pick up a copy of it. It could be ordered through Amazon.com or Barnes & Noble. The book is loaded with useful financial planning tips. In addition to that, the second version, which is the green covered book, has a new chapter dedicated to dental practices and the specific strategies you could use to save more of what you make. So with that said, once again, thank you for attending the presentation. I'd like to wish each of you the very best of success. Have a great day and enjoy.